From Holland's 1700s Tulip Mania to the wild Bitcoin boom of 2017, history is filled with financial bubbles that captivated and crushed investors. In this video, we'll explore the fascinating stories behind these infamous manias, from the Dutch trading tulips for entire homes to the Roaring Twenties stock market frenzy, the dot-com craze of the late 1990s, the housing crisis of 2008, and the volatile rise and fall of cryptocurrencies. Let's get started. Tulip Mania. The original bubble. Let's start with Tulip Mania, the original bubble. The 1700s in Holland was a time when tulips were more valuable than houses. These delicate flowers became the hottest commodity, with prices skyrocketing faster than you can say botanical insanity. Back then, the Dutch were known for their strict Calvinist lifestyle, which meant no flashy clothes or ostentatious displays of wealth. So how did they show off their newfound riches? By investing in tulips, of course. They could carry around a tulip or two and still look pious. Imagine walking into a coffee shop today and casually flaunting your wealth with a bouquet of roses. Ridiculous, right? But things got even crazier when the Dutch started trading tulip futures, contracts that allowed people to buy tulips before they even bloomed. It was a financial frenzy. The prices went up, and people were willing to trade entire houses for a single tulip. Inevitably, the bubble burst. The market crashed, and those precious tulips were suddenly worth less than a sack of onions. The speculators were left with nothing but wilted flowers and broken dreams. Surprisingly, the Dutch economy didn't collapse, and there were no mass bankruptcies. But the lesson was clear. Investing in flowers might not be the most stable financial strategy. The Great Depression, 1929. Fast forward to the 20s in the United States. It was a decade of jazz, flappers, and unprecedented economic growth. The stock market was the place to be, and everyone wanted a piece of the action. It was like the Wild West, but instead of gunslingers, there were stockbrokers. And instead of duels, there were margin calls. Margin trading allowed people to buy stocks with borrowed money. You only needed a small amount of your own cash, and you could borrow the rest. It was like playing with house money, but when the house is a casino on steroids. As the stock market soared, so did the levels of speculation. Banks saw an opportunity and started lending more money for stock purchases. When they ran out of money, they borrowed from other banks. Loans on top of loans created a precarious house of cards. People were living the high life, investing in stocks like there was no tomorrow. But tomorrow came, and it wasn't pretty. On October 29, 1929, known as Black Tuesday, the stock market crashed. It was a financial apocalypse. Fortunes vanished overnight, and panic spread like wildfire. Brokers made margin calls, demanding repayment from investors who didn't have the cash. People were desperate, selling everything they owned to cover their losses. The crash led to the Great Depression, a period of economic hardship that lasted for a decade. 1 in 4 Americans was out of work, and half of the US banks went bankrupt. It was a grim reminder that borrowing money to gamble on the stock market isn't a foolproof plan. Spoiler alert, it's actually a pretty terrible idea. The dot-com bubble, late 1990s. The late 1990s was an era of dial-up internet, AOL chat rooms, and the birth of the dot-com bubble. It was a time when tech startups were popping up like mushrooms after a rainstorm. Everyone wanted a piece of the internet revolution, and investors were throwing money at anything with a .com in its name. Valuations for tech companies reached absurd levels. Startups with no revenue, no profits, and sometimes not even a viable product were valued in the billions. It was like a financial reality show where the only requirement for success was a catchy name and a snazzy website. People were buying stocks with the same fervor as a Black Friday sale, believing that the internet was going to change the world, which it did, just not in the way they expected. But as history loves to repeat itself, the bubble burst. By 2000, the dot-com bubble deflated, wiping out trillions in market value. Companies that were once the darlings of Wall Street vanished overnight. It was a brutal wake-up call for investors who had believed that the internet would make them overnight millionaires. The housing crisis of 2008. The 2008 housing crisis was a financial disaster that shook the global economy to its core. This story involves mortgages, risky bets, and a lot of fancy financial jargon that sounds like it belongs in a James Bond movie. In the early 2000s, everyone wanted to own a house. Banks were more than happy to oblige, offering subprime mortgages to people with questionable credit histories. It was like giving a teenager a credit card with no limit. What could possibly go wrong? These subprime loans were bundled into mortgage-backed securities, which were then sold to investors. The idea was that these investments were safe because they were backed by real estate. But when you package a bunch of bad loans together, you get a lot of bad loans. To make matters worse, financial institutions created even more complex products like collateralized debt obligations, CDOs, which were basically bets on these mortgage-backed securities. It was a house of cards built on a foundation of sand. When homeowners started defaulting on their loans, the whole system came crashing down. Housing prices plummeted, and the value of these mortgage-backed securities evaporated. Banks and investment firms were left holding the bag, and many of them went bankrupt. The US government had to step in with a massive bailout of $150 billion to prevent a complete economic meltdown. It was a sobering reminder that betting on people's ability to pay their mortgages, especially when those mortgages are subprime, is a risky business. Bitcoin boom and bust, 2017 to 2018. Let's fast forward to the wild world of cryptocurrency. In 2017, Bitcoin was the hottest ticket in town. Its price soared to unimaginable heights, and everyone from tech enthusiasts to your grandma wanted in on the action. Bitcoin promised to revolutionize the financial world. It was decentralized, anonymous, and free from government control. It was the future of money, or so we were told. The price surged, driven by a mix of genuine innovation and a massive dose of the fear of missing out. But what goes up must come down. By early 2018, the bubble burst. Bitcoin's value plummeted, and investors who had bought in at the peak were left with massive losses. It was a digital gold rush gone wrong. The cryptocurrency market remains volatile, and while Bitcoin has made a comeback, the wild swings in its price serve as a reminder of the risks involved. Lessons learned? So, what have we learned from these financial flops? First, that history loves to repeat itself. Speculation and risky investments have been driving financial crises for centuries. Whether it's tulips, stocks, real estate, or digital currency, the allure of quick profits can lead to disaster. Second, we need to understand the risks involved in investing. Borrowing money to invest, whether through margin trading or subprime mortgages, can lead to catastrophic losses. It's crucial to do your homework and understand what you're getting into. Finally, we need to recognize that while financial markets can offer great opportunities, they also come with great risks. It's important to diversify your investments and not put all your eggs in one basket, or all your money in one tulip. Who's to blame? So, who's to blame for these financial fiascos? Is it the greedy speculators, the reckless banks, or the uninformed masses? The truth is, it's a bit of all three. Greed, fear, and a lack of understanding drive financial bubbles and crashes. But at the end of the day, we all have a role to play. By educating ourselves and making informed decisions, we can help prevent future financial disasters. Let's learn from the past and avoid repeating these costly mistakes. Thank you for joining us on Affluent Empire. Stay tuned for more insights and analysis on the economy, cryptocurrency, and beyond. Don't forget to like, subscribe, and hit the notification bell so you never miss an update.